You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to refer to around here as the Options Insider Radio Network. 13 programs on the old network, including well over 100 archived hours. Archived goodness, if you will, of the Volatility Views program. Great guests, great analysis, all sorts of good stuff. Where can you find all of that volatility goodness? Well, of course, the mothership, the flagship, theoptionsinsider.com. I know a lot of you have been asking if we can make it easier for you guys to read the show notes directly from the website. So we've done some tinkering behind the scenes, and now we've done just that. It used to be you had to have a little snippet of the show notes, then you had to click on it to get more. Now it's all there, readily available for you, so you can read along with the show notes, all that fun stuff. So making it even easier for you guys to enjoy the show via the site. Of course, the website isn't the only place you can get it. No, not by a long shot. iTunes, Stitcher, TuneIn, all of your favorite leading podcast platforms. We're there. If we're on one, or excuse me, if we're not on one and you think we should be, let us know. We'll look into it. We're checking out the SoundCloud one. Actually, not SoundCloud, but the new one, Spotify. That's the one. So we'll check that out for you. I know a few of you have written in saying, hey, are you going to be on the new Spotify podcast platform? We're going to certainly do our darndest. And, of course, if that's all too much for you, just grab our mobile app available for iOS, Android, and indeed the Fire OS. And joining me on the old Volatility Views program, my volatility nemesis, none other than the greasy meatball himself, Mr. Mark Sebastian from OptionPit.com, as well as numerous and myriad other endeavors throughout the world of options. Mr. Greasy Meatball, welcome back to the program, sir.
Yes, your volatility vice is here.
You are indeed, and I hear someone's dialing on the Volatility Vice phone.
That was me on the Volatility iPhone.
I'm guessing you're on mobile today. Where are you beaming in from today, sir?
I'm actually in my office. There's a couple of people using it. I share some space, so I needed to find a little more private area, and that is where I'm at.
Volatility Views does require some privacy. Yes, it does.
It does, especially with my voice. I don't know if you know this, but it does. It carries a touch.
It can grate a bit on the masses. That's why we dial you back in the post-production. We have the Sebastian filter ready to go, just to give you a more manly timbre to your voice.
I appreciate that. So that's very nice.
I know it takes a few extra hours of post-production, but we think it's worth it.
How was the Option Alliance event yesterday?
It was great. Listeners, if you're not sure what he's referring to, that is indeed the event we put on here for financial-oriented and like-minded entrepreneurs here in the city of Chicago. We have people flying from other cities, of course, but our events are usually centered here in Chicago. Great turnout. A lot of people come in, a lot of new faces, which was fun. We partnered with the FinTech Exchange and a few other people here locally to drive some other financially minded entrepreneurs, people particularly interested in FinTech and others. We had it in a great venue here called Trading in Chicago, which is kind of like a startup hub, if you will, or just at least a co-working space for the trading community, something we talked about doing at the Options Alliance for a long time. So listeners, if you missed it and you're going to be in the Chicagoland area coming up soon, let us know. We'll let you know what our upcoming Options Alliance event schedule is, or of course, just surf on over to optionsalliance.org to learn more. All right, and with all that underway and the team assembled, we're going to dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
I always end up dancing to myself over here whenever I hear those intros, Mark. So it's always dangerous. I want to keep them playing for too long. But of course, we have business to get to. There's no time for dancing here on the old Volatility Review show. This is indeed the Volatility Review segment. This is the portion of the show where we look back on the week that was from a volatility analysis and trading perspective. It was an interesting week, at least earlier in the week as we're recording this today. It is Friday, May 29th. It seems like most of that excitement has kind of left the room. Not a hell of a lot going on across the markets really today. Most of the major indices off fractionally on the day, but nothing to speak of. Certainly not as robust of a sell-off as we saw earlier this week, where the S&Ps and others were off over 1% during the session. I'm not seeing that today, only off fractionally on the day. VIX cash ticking up ever so slightly into the weekend here, hovering around the 13.5 level. We, of course, saw a little bit more aggressive action earlier this week, as I alluded to, and the S&P sold off a little bit more aggressively than it's doing today, and we saw VIX cash popping into the 14 handle. We saw that front month future out there in VIX land flirting with a 15 handle briefly out there as well, and just kind of teasing us ever so close to that. So some interesting action earlier this week, Mark, and perhaps we'll start there. Tell us what you saw kind of when things were really rocking and rolling, as well as later in the week when things seemed to have ebbed a little bit.
Yeah, it was interesting. I was looking at Friday or Monday, and that was it was looking like a really decent sized sell-off, and at no point in time did the VIX futures really react to anything. We had the VIX up, I think, near 14.5 at one point, and the June future was only up 50 cents. And I'm just looking, I'm like, well, this is clearly everybody thinks this is a one-off event. And then obviously we got the nice rally the next day, and then here we are today, and kind of the same thing. Down 15 handles at one point, and the VIX futures are up, up at the most 40 cents. I mean, they never really reacted, even though the cash did a little bit, but just a total la-di-da, blase, who cares in the option markets to all of these sell-offs. Nobody believes them at this point. And, I think the VIX futures action kind of proves that point. Now, one interesting piece I remember was that there was a point earlier in the week where both those new Aeschylus shares, we had the VIX up like 15%, the VXX up like 4%, and the Aeschylus shares were only up like 2%. And then at a certain point, I looked, and VX up and VX down were both up. It was really odd. And
that doesn't seem to be right.
It does not seem to be correct.
That doesn't seem to be what they're talking about with that product.
Yeah, that product it's interesting, but I don't think it's doing its job. It'll be interesting to see what this rollover looks like. They've been doing about 85,000 shares a day, so I'll be interested to see where that goes. But little uptick in at least intraday realized volatility, but still not a lot. And the other pieces, we're seeing a lot more of, like, in the single names where the stock gets sold off and the vol gets sold off. And, you've got a stock just creeping lower and the volatility coming in at the same time. That's always a really odd market. But, it seems like whether the underlying is going up or down, volatility is coming in. And that's kind of the way things have placed themselves leading into June.
Yeah, it's interesting. I was looking and getting some stuff ready for the show about an hour ago, and I thought my stats were broken, actually, for a while there, because I just couldn't believe the numbers I was seeing come out of VIX. It was almost halfway through the session, and only 63,000 contracts had traded. I can't remember the last time I saw VIX doing that anemic of a volume, so I had to check a couple other platforms, and sure enough, my numbers were right. but it just left off the page. These must be broken. This can't be right. And even today, they've done a little bit more since then, about 130,000 now, but still just some volume the last hour ticking into the VIX pit. But overall, just an anemic day and an anemic week for volatility overall. Of course, we're coming off the truncated holiday week here in the States. So we started off strong with a little bit of sell-off beginning of the week and about 363,000 or so contracts going up. That was pretty much the best day VIX had for the week. The rest of the week, it pretty much never looked back, never came close to those levels. 209,000 on Wednesday, only 160,000 on Thursday, and so far at least we're still well shy of that today, only 139,000 or so. So we might flirt with the 160,000 level today, but it didn't look like that way an hour ago. 60,000 contracts. That was pretty rough. But despite this anemic volume we've seen this week, there still is a fairly sizable open interest out here in the product, more than what people might think. About a little over 6 million contracts open out there in VIX land, about 4.75 million or so on the call side, on about 1.3 million on the put. So getting a little bit heavier calls over puts. Still, it's only about 2.5. Actually, current open interest is about 3.6 to 1, so it's getting a little bit heavier. Average is about 2.5 or so usually. So getting a little bit heavier, still not in the 4 or so range that we've seen recently, where people start to lose their minds. VIX is too call heavy. What does that mean? Is it bearish? Is it bullish? Et cetera, et cetera. The big strikes, of course, you chop out the our friends out there who did 1.08 million contracts in the trade, and that open interest looks a little bit lighter. But still, the June 18s leading the charge. And that was pretty much 464,000 contracts. That seemed to be the lion's share of whatever heavy volume there was this week in VIX. It seemed to be primarily call buyers and primarily near term, primarily in June. They were buying kind of the strip from like 17 to 20 in various sizes on various days. That seemed to be the only real kind of reliable paper we saw going up this week. So people still at least picking up some near-term protection or hedges or specs in June here in VIX land. Mark, has that kind of been your takeaway as well from what little paper we've seen? It seems to be primarily migrated to the upside in the June wing there.
Yeah, we've got, the market's been for the most part la-di-da toward this Greece thing, but, you do have some people coming in and hedging off Greek risk if for some reason things really do fall apart, and that's why I think we've seen that volume drive in June. I mean, without Greece and like some sort of risk out of there, I don't know where VIX would be, but it would be even lower than it is now.
Yeah, if we didn't have that little sell-off this week too, that was pretty much the only thing that gave us any life. Other than that, yeah, it's really been just a rough week to try to find any real drivers. Earnings kind of on the tail end of that now, so not a lot of big earnings surprises. We saw most of the retailers coming out recently, and that moved the market a little bit. Things like Costco and Walmart and Mickey D's and a few other big names. But other than that, most of the names that people really glom onto for earnings season are pretty much done at this point. No Apples in our future. We do have some Google events going on right now, so maybe that'll move the market a little bit. But other than that, not a heck of a lot really to look forward to. Let's move over to the realm. You were alluding to it earlier, Mark, the realm of the ETPs, the volatility ETPs. We talk about those a little bit every now and then on the show. We probably should get more into them. So we'll start doing that today, talking about, of course, the number one ETP, sometimes the number one exchange traded product by volume, which to me is still mind-boggling, is, of course, a product we often malign on this and other programs on the network, sometimes fairly, sometimes unfairly. That is, of course, VXX. It's been averaging about 39.5 million shares a day of late, so still lighting it up, even though that's a bit below its other levels. And on the option side, about 233,000 contracts a day. So with VIX at these anemic volume levels, VXX is actually trumping it many days these days, which is not something we saw a lot back when VIX was doing 700,000 to 1 million contracts a day. Seems like there was a lot of love over the past week out there. Puts were kind of the order of the day out there in VXX land of late. And Mark, I want to get your opinion on this. We saw a lot of, throughout the week, kind of scattered buyers of, looks like the Jan 20 puts were kind of the strike du jour, but we profiled on the site yesterday, kind of interesting one as well. This kind of gets back to your point you were making last week about UVXY as well, about how that one it just did its reverse split, and just the long-term puts are a no-brainer. Seems like we're seeing the same play happen again out there in VXX land. We profiled yesterday on the Options Insider a big trade out there in the VXX Jan 2017, 7 puts. If you're not following VXX or you haven't done so in a while, that's a fair bit off of where it's trading right now, just a little bit shy of the 19 handle. So that's pretty much over a 50% decline they're specking on out there by Jan 2017. I picked it up for about 40 cents, 12,500 times. So that's some serious size. We also saw some paper out there, I believe it was the Jan 2016s as well, going up for some size as well. That was more scattered paper, buyers and sellers. So a lot of long-term paper out there. It seems like, Mark, this is the play du jour. We were joking about it last week. These puts should be bid up out of control. It seems like they're starting to get that with people filtering back into their long-term contango/decay bids in these puts.
Yeah, people use these little pops as an opportunity to try and find, long-term stuff that takes advantage of contango to basically kind of position themselves to do well if and when VXX is back to its 4-for-1 reverse split land, which will, it may not happen it won't happen, I don't think, in 2015, but probably early 2016 if we kind of stayed here. So that's an excellent opportunity for people to step in and go out and buy like 2017 stuff for what is perceived as relatively cheap, and to try and take advantage of the increase in the roll yield and contango capture, if you will, from VXX.
Yeah, it looked like initially that trade going up in VXX was a bit of a roll. I think they were rolling because there was a ton of size on the Jan 2016 10-put strike out there in VXX, and pretty much negligible open interest on the Jan 2017 7-put strike. And it seemed like they were about similar size trades going up, so it seemed like a no-brainer roll. But your cohort there, the Rock Lobster, was adamant that it was not. And on further digging, it looks like it was some scattered paper. A little bit of a spread went up, but also it looks like scattered paper on those Jan 2016 10s. Actually, looks like a lot of it was additive because the open interest is even higher now. So someone not only loading up on the Jan 2017 7s, but loading up on the Jan 2016 10s as well. There's about nearly 50,000 open of those puts right now. So people loving them some long-term contango out there in VXX. I can't argue against them. I know last week you were working some bids as well. Did you ever get filled?
Yeah, actually I did. So and just in my IRA, I've got some UVXY 30 puts in 2017 and some 20 puts in 2017.
Now, that's what I was saying to someone earlier this week, actually. That's a great IRA type trade because it's obviously very long term. You kind of want to just sit on it for a while, so you don't want to probably have it tying up capital in your active trading account. People are always writing in, hey, what can I do with options from an IRA perspective? And you can do a lot of things, obviously, but that's one we don't hit on enough. And it might be an interesting trade for people is, long term contango plays because they do work out fairly well. And it's, something you need to set and forget anyway. So park it in your IRA, check it in every now and then. Maybe you need to adjust, but probably not. And it might be an interesting trade and certainly something to jazz it up aside from all the usual covered calls and collars and things that everyone else does out there in IRAs on a daily basis. Moving over to another product we haven't talked about in a while. I think there's a reason for this, Mark, is it kind of doesn't do anything. It's kind of one we used to kind of wring our hands about a lot and say, what the heck is going on out here? This is, of course, our old friend VXXT. That is the short-term volatility index, hovering right around the 13.25 handle right now, up about $1 today, so moving a wee bit more than the mothership VIX is today. Open interest, a whopping 4 contracts, total volume 0. And it seems like, and Mark, maybe you can confirm if you heard this as well, it seems like they're not really listing any more strikes on this. It goes out 4 weeks to this third week of June about, and that's really about it. So it seems like what a lot of people assumed will probably happen is that when the VIX weeklies go live, they'll kind of subsume or consume the VXST and take over for it. It seems like that's probably what they're doing. Is that what you've been hearing as well?
Yeah, I think that's the plan. So, I mean, because really VXST doesn't hedge anything. It doesn't. And so, I think we had a couple of weeks back when we had Ewan on and we were talking about VXST, and he said, if you're designing a trade for traders, you're going to have something that doesn't work out at all, because traders are not even the gnat on the tail, not even the wing on the gnat on the tail of the dog. which I always thought was hilarious.
He's known for a good colorful quip every now and then, Ewan.
Indeed he is. And yeah, that thing is going the way of the dodo. And this is just a little. I wanted to take things a little off topic, Mark, but I don't know if you saw what happened in Humana today. I thought we could talk a little timeliness, or do you want to save this?
Let's do it. Let's dive into it.
Yeah,
let's chat about it because I've been running around all day, so I haven't had a chance to check out Humana.
Right. So Humana was trading like around 172 or something like that, and you can tell. And the folks, you want the definition of a cheater. I'm going to give you the definition of a cheater right now. So Humana is trading 170 or something. A guy comes in and sweeps the 180 calls. Buys like a few hundred of them, and pays a quarter. And these are the ones expiring next Friday, so a week to go. And they're $9 out of the money or something like that. And then within 30 seconds of his sweep, the stock halts. And rumors that they're potentially going to merge, and the stock opens up 207 or 208, and so the guy made a 10,800% return in about 4 minutes of work.
Not bad for 4 minutes.
So yeah, he paid a quarter, and then they were trading $27. So for every 100 that he made, he turned a $250 investment into $27,000.
I'm looking here. It's like a total of nearly 600. These are the 180s in the first week of May. There, you're talking about?
Yeah. Do you see those ones? Now,
yes,
those don't expire today. I think they expire next week, right?
Let me pull those up and see. No, actually, they go out today. So that is.
Oh, nice. So the jerk got them really good.
Extremely gammarific, shall we say?
Yeah, he just ruined the pit on 200 contracts. So did you see how many of those actually traded a quarter?
I'm pulling up here now. A total of nearly 600 went up on.
Oh, he's probably sold them out already.
So that's what I'm thinking. He probably already got out of them. Which, if that's the case, is kind of interesting because one thing I have noticed. Obviously, we do a lot of unusual activity at the Options Insider Listen. And one thing I have noticed over the past year or so is it seems like they're getting better at freezing some of these guys who are clearly and demonstrably, doing something untoward. They have some knowledge. They have something that they probably shouldn't be doing. And so we're seeing people put these trades on, but not often get them off. Yeah, I'm looking here, Mark, and it was a 110 lot on the Amex going up for a quarter, paper buying, 212 going up for a quarter, paper buying like a same second, really. So I was on the Philly, so he was doing intermarket sweeps. He pretty much came through and swept. He got every offer he could. He got everything in the book that he could. Looks like he got about a total, 312, 4. Looks like he got all 500 and so were all of his buys. So he hasn't gotten out yet. That's all him lifting offers on that paper. He got all that for a quarter, pretty much. So only kind that didn't trade for a quarter. A two lot went up 11 minutes later for nearly $27.
He bought like 500 of these.
So you got like 500 of them for a quarter, and then two of them traded 10 minutes later for almost $27. So
how much money did he theoretically make then on that? On
500? Yeah, about 500. And let's see, he did 500. These are crazy. I'm just laughing. I'm sorry. It's taking me off. You don't see a lot of these so naked that they're that bad. I don't have the exact high of. They're going up about 32 and a quarter or so right now. Yeah, you're talking if he just got out of them right now, which he hasn't done, he's talking a cool $1.6 million. And that's just hitting the bid.
$12,000 investment.
I don't think he's going to work that offer if he's here. He's not going to try to work it for like a 33. He can get a handle better probably. He's just going to hit. He'd be smart. But it looks like he hasn't gotten out of them yet, so that gives me some hope that some sane individual somewhere at an exchange or a broker said, yeah, this one, this is a flag, and we need to freeze this. So
exactly.
Hopefully, the open interest is about 600 and change with these contracts going up today. Hopefully, that'll still be that tomorrow. And
that'd be nice. I mean, people, if you think you hear us laughing, and we're not laughing because we're like, ha ha ha, this is hilarious that this guy did this. We're laughing because we're like, it's a combination of being flabbergasted and like angry. And like when something just so ridiculously screws you over that you can't just help but just kind of laugh about it. It's a combination of just infuriation and incredulity.
That's an easy one.
Say that
That's a fun one to say.
Incredulity. So.
Yeah, I know the guys who aren't laughing is the market makers on the other side of those 600 Granted, there's enough times they probably got their stock, but still, that's the big concern is getting run over delta wise at that point. So at least they got the stock. So it wasn't hopefully unless they worked it, unless they were being kind of. I mean, they weren't that high of a delta, so they may have just let them ride. And if that's the case, then you're wearing some ugly stuff right now.
Yeah,
so that pit is splitting up about a $1.6 million loss if that's the case. Which that'll leave a mark in this day and age when edge is few and far between, shall we say?
Yeah, and the funny part is that that guy's account will get frozen, and like he'll have his profits disgorged. They won't be given back to the market makers.
Oh no.
No, so the market makers lost. And the guy loses. So the only people that end up winning on a cheater like that is the regulators. So FINRA will keep.
Yeah, the SEC and FINRA will keep the lion's share of that.
Yeah, no kidding.
And maybe some of the exchange regulatory people, maybe they get a piece of that too. I don't know. But
maybe
either way, yeah, that's funny. And people always say, we're looking for unusual activity. It's got to be 10,000 lots. No, a lot of it goes up in the sub. This is almost 600 contracts, and that's a fair amount for what we're looking at. He made a decent amount, so it's enough. But yeah, that's a good one. That'll go in our unusual activity. Just I think for the sheer audacity of it, Scoop, he didn't even waste time. He didn't pretend to buy the Dees so he can say, hey, I didn't know I bought Dees, or he didn't try to buy something else with it or anything like that. Didn't do a spread. He just naked came in. He said, I know this is moving in the next 10 minutes. I want whatever I can get right now as fast. I want all of them. And this is pretty much every red flag you can think of. So hopefully this guy.
And how many times do I have to tell people, if you're going to cheat by selling puts to the market makers? That way they won't complain, and then you'll get away with it. So, like, imagine this. Imagine if instead of paying a quarter for those, he had simply sold the 190 calls at, 15 or 16 bucks, and done that in size and done it at all the varying strikes. The market makers absolutely would have hedged, and they'd all be sitting on a pretty penny, and he'd be keeping all of his puts. Like, really, it's not that hard. Cheat the right way, people.
Yeah, this guy either didn't have time or the wherewithal, or maybe both. He said, I got to have him, and I got to have him now.
Or he's just a cheater.
Yeah, this is not. Yeah, I think the latter. This does not surprise me. I remember all my time out in SPX. We saw a lot of these when news was breaking, and some Capitol Hill staffer had it before us that some Treasury secretary was stepping down or something like that, and the spoos were about to take a hit. Guess what? Every phone in the pit lit up to lift offers on puts. So subtlety in those moments is a lost art. They're not out there to leg into some crazy risk reversal or something like that. They want to get all your short or long deltas that they can get, and they want them now. And our friend clearly leaning that way. So that's a little fun nugget for our listeners here to dive into. More of a gamma than a vol trade, but still an interesting one nonetheless. I want to jump back for a second, Mark, something you were just talking about. Our old friends there, relatively new friends actually, but we seem like we've been talking to them for a while. These are, of course, the VX up and the VX down, doing, like we said, a fair amount of volume. The VX up has been averaging. That seems to be the far and away the winner. People, obviously, in this environment, VIX hovering on the lower teens, not looking too much for a lot of downside. So the VX up hovering around 78,000. That's what it's been averaging of late. The VIX down only averaging a 31,000. Of course, you mentioned that weird aberrant day where they're kind of both moving in lockstep. I'll have to dig into that one a bit to see what the heck was going on there, because that doesn't seem to really be right. But that said, we have seen some weird stuff. Few people have written in to point out, though, that 78,000 volume doesn't carry a lot of actual notional vega in there. It depends how you break it down. It's not that many futures, VIX Futures worth of vega. So I mean, it sounds a lot, 78,000 contract or whatever shares in this case, but the actual amount of vol that's being traded there, perhaps not as much as you might think.
Yeah, it's not a lot. It's like something like 10 or 15 futures a day. I think I calculated that 500 shares is one future along those lines. So Yeah, absolutely.
But, that weird aberrant day aside, how it's been a few days now, about a week or two now, we have a few trading sessions under our belt here for these products. We kind of debated at their onset, what were they going to do? What were they for? How well would they actually track spot VIX? And, that one weird day aside, what's your take on them so far? Aside from the volume and everything else, do you think they're doing a fair job of delivering what they're promising here, giving you an actual tradable spot VIX product?
No, but they're doing a fairly decent job of doing a tradable from a VIX future in an ETF. That's really a lot closer to how it's trading. And so, if you're looking for something that is just kind of a tradable VIX future, then in an ETF, that's kind of what you're getting with that product. In my experience.
Yeah, and we've said before, that's kind of not really what they promised either. They promised a bunch of things that they're not delivering. But if they deliver that other thing instead, which is essentially a futures-like product, a futures-ish type product that you can put in a securities account, a lot of people have been trying to do that for a long time with varying degrees of success. Most of them not that much. So if they can succeed at that, that might actually be an interesting prospect. And again, it's kind of like the third iteration, the third derivation of what they were talking about with this product. But if that's what they actually deliver, that might have some interest for our listeners, the hardcore volatility crowd who wants something like that and sees the value in something like that. If they're looking for the contango-less product or the pure spot VIX, yeah, not so much. But if they want some sort of futures-esque product that they can put in their securities account that gives them some vol exposure, that may or may not be an interesting thing. Like I said, we're going to get those guys on the show. I want to get their kind of viewpoint because it seems like this product has really evolved a lot since its initial conception. It has a lot of iterations. It's interesting to me, they're still kind of beating the drum as this product being for people out there who have suffered at the hands of contango in VIX, and yet they say themselves, you shouldn't buy and hold this thing. So I don't know. Yeah. That seems like a bit of a mixed message to me. So I definitely want to ask them about that because that's clearly not what this product is for.
Well, I think that the nice piece is that instead of there's an explicit charge to owning it as opposed to an implicit one with like VXX. And so, at least if they've got a future that kind of a tradable VIX future with an explicit charge, then, you've got something there at least.
Yeah, you're right. It is explicit, at least. I mean, it may be confusing as hell, but at least they're upfront with here's what we're going to charge. Here's how this thing works. Here's all these various distributions with VIX under 30, VIX over 30. Here's how it breaks down in those scenarios. So you're right. At least they are upfront with what they're doing. I do like that they add on a little bit of special sauce, a little bit of extra fee for those VIX down people because they know that they need a little bit of extra, a little extra incentive to get them on board. So they charge the VIX up guys, 0.15%, and they give that to the VIX down guys. There's a little bit of extra incentive to touch that product.
Yeah, it's definitely interesting.
It's an interesting way to go about it. They know off the bat, and the volume certainly reflects that the VIX down is probably going to be the loser, at least with VIX south of 30. And so they're giving a little bit of extra secret sauce, extra sweetener to those products. Speaking of products, let's move on to the other product that's exhibiting, more of a steady vol decrease of late. We've talked a lot about over the past 6 months about how this product has been vacillating back and forth from a skew perspective and certainly from a vol perspective. We saw some serious highs. Of course, I'm talking about crude oil. Saw some serious highs out there in products like OIV and OVX that, of course, track the volatility in the different products. One, of course, the USO ETF, one, the crude oil options out there. And they both spiked earlier in the year, as you might imagine, the February to March timeframe, high of about 71 or so in OIV, and down to even a few months ago in March of trading into the 60s. Well off that now, trading in the low 30s, 33 for the case of OIV, 32.5 or so for OVX. So they're still coming well off those early highs. And I'd imagine if you pull up the skew right now, I mean, it certainly has been for a while, but it would still be very heavily to the upside, though. Once they hit that 60 handle, that seemed to be kind of the magic level where, support and resistance kind of meeting there, and we're probably looking to see some more bearish sentiment out there as well. So we might see actually a little vol pickup out here in crude land sometime in the near future if we get a bit of a retracement out here. Mark, what's catching your eye out there in crude oil land aside from the fact that vol is steadily drifting south, at least for the time being?
Yeah, and vol should be. I mean, it's up a little bit today, but we've seen a steady decline in realized volatility, and we've got OIV and OVX both threatening to break 30, and I think there's still a sale. Now is the time to really get short that stuff. There was easy money from kind of 60 down to 50. Then there was kind of a fight between 40 and 50, and now the drop from low 30s to the 20s is usually a relatively the least rocky one. So you're selling a lower vol, but you're probably get to buy something a lot cheaper. And it's the old saying with volatility, it's not really about buy low and sell high, or vice versa. It's about sell low and buy lower, and buy high and buy higher and sell higher. And that's really the right way to trade volatility. And that's what I'm seeing in OVX and OIV and their option prices.
It's interesting. People always complain about these different ETF products and how well or perhaps not well they track the underlying, and USO always comes under that heat. People write into us all the time, why does this one do this? And a lot of people probably loaded up on USO, maybe rightfully or wrongfully, depending on your viewpoint, thinking that they would load up, have a nice long-term pick here on crude retracing. And if you have done that, you've done all right. If you pick the lows out there in USO of recently, I think they got down to about just flirting a little bit shy of the 16 handle, now a little bit over 20. So you've done all right. But certainly not the 50% you've seen in some of the big crude products over the past few months. So I think that's why a lot of people get so up in arms with these ETFs. Of course, we said it many times on this show. USO, not a direct proxy for crude, and it shouldn't be viewed as such. You'd be surprised, Mark, how much email we still get on things like that.
I know.
Hey, why does this not work? Why does this not do it? So I just want to put it out there again. Stop emailing
When
me.
people say, how should I trade oil? I say, go and trade oil.
Yeah, I mean, if you want the product, I mean, GLD and SLV kind of being the two exceptions, they do a really good job. But aside from that, there are not many other, ETFs and ETPs that they recommend wholeheartedly as a surrogate for the product itself,
No, I mean, the only way you could really create like a oil product that actually tracked oil prices would be to create something that carries the physical. And, I don't know who owns Cushing, but if the Cushing people decided they wanted to create an ETF based on the physical, I mean, maybe they could do something like that, or Exxon could do something like that on its own crude. But that's not their business model, and that's not what they do. So you would literally have to go out and buy just a bunch of oil, and then every time you create a unit, buy another barrel of oil and just store it somewhere, and that would be the management fee.
Yeah,
and
the storage fee.
That would be how you do it.
You become overnight one of the largest holders of crude on the planet,
in the world,
just to manage that ETF. But it might.
Yeah.
I don't know. The interest in that, at least now, might be worth it. I don't know. There's still a lot in there. You're right. You have to have storage capacity and everything else. That's a huge nightmare. Shipping the contango on that, just from built in all those storage costs, would be enormous.
Well, and at the top, you'd have all sorts of destruction of units, and you'd be, there would be some value in that. You'd have people. Basically, you'd be in the market buying and selling oil every day, which would be kind of interesting in the cash market.
I'm sure someone has done the study what the bare number of units of oil you could have to make that a product viable.
It'd be interesting. I mean, if you made the underlying 1 barrel of oil, I mean, 1 million barrels. That's you could have open. You could launch with 1 million shares, so that would only be $58 million.
Yeah, that's certainly doable from a storage capacity. I mean, you'd probably churn that float pretty quick, but you'd at least have something.
Exactly.
A lot of big names out there now. Right now, like what is it? Shake Shack making a lot of news because they don't have enough float to list options. But they only have about 5.6 million open, or shares floating out there. So
a smart person would create the product. Would work with a oil refiner or oil storage person, and actually would be able to create it against the internal reserves. Something like that. That'd be interesting.
You think a lot of opportunities for that, and again, we're not this week in crude oil, even though we probably could be.
Or
so
heck,
much
do a
land
survey. Do a land survey. Buy a bunch of land. Figure out how much oil you have in your land, and actually, you instead of actually pumping it, just sell against your land reserves.
I'm constantly amazed how many people don't really, live up to their full potential in the crude market. Airlines being another great example. Southwest, the reason they had such an edge for a long time, they were the only airline that really hedged their crude exposure. You think if you're going to be running an airline and one of your pretty much primary risks is the price of crude, you would hedge that on a regular basis.
Yeah,
and certainly when it got down to the low 40s, you were loading up on everything in the planet. And yet, I don't know. It's amazing how many airlines don't even do that. So they have one fundamental risk. They don't do it, let alone anyone out there working. But if you're out there, if you're working to construct a ETF that actually tracks crude and holds the physical, let us know. We want to hear from you. It would be interesting to see. I'm sure someone out there has done the legwork, Mark, so we don't have to do it. Meanwhile, let's move on. Let's get some of your questions. It's time to check in on the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the volatility voicemail segment. Like the man said, this is the portion of the show where you guys get your turn on the old volatility views panel with your questions, your comments, your insights. No shortage of ways for you guys to do this, just like the man said. So let us know. We'd love to hear from you guys, your questions, your comments. You guys have some great ones all the time, so we love to get your stuff. We'll read all of them. We don't always answer all of them on the show. We just don't have time. But send them in. We love to hear from you. Anyway, all right, first off, kicking us off here today, we have a listener. Goes by the fancy handle of Aeschylus, I believe that is pronounced, and he writes, or she, one thing I can't understand clearly is why there is so much focus on the volatility smile. Given my knowledge of the Black Scholes model, this is what I get. People use the volatility smile as a forecast of future volatility. They assume that the market is 100% efficient, and everyone would engage in dynamic hedging if they could, or that everyone agrees that the Black Scholes model gives the, quote, fair price for the option, whatever it means to them. Therefore, any difference between the market price and the Black Scholes price shouldn't be interpreted as an opportunity for arbitrage or a presence of model risk, but what the, quote, market is saying the Black Scholes parameters should be. In special, the volatility the market is predicting for the future time until the maturity of the European option. I'm not sure what he means by in special there. It might just be a typo. But interesting point here, Aeschylus. And this is kind of, I think, what we've said on the show many times. The smile, a.k.a. the skew, is kind of just, like you said, your projection, your forecast. That's what the model is showing you right now. But we've said many times, and certainly any professional volatility trader or trader in general knows that that is not constant, that is not the law that which the market must abide by. There's a million things that could happen as the market moves up and you travel up one leg or down one wing of the skew, and you're probably not going to stick to that. If you move very fast, it's going to be a different type of movement than if you move gradually along that skew curve, in which case you might stick to that curve a little bit more than you would in some dramatic aberration. Of course, if order flow starts coming in, it's going to, one-sided order flow, it's going to change the way that skew looks. There's a lot of things that, could make that skew inaccurate, or once you move to that new strike, that new underlying handle makes that skew not as relevant. Things have changed in the marketplace. So yeah, it very much is kind of the market's guesstimate looking forward where the vol should be at these different strikes. But yeah, I agree with you. I don't think most people really see it as some definite arbitrage opportunity if you're a few points away from where the skew says you should be at that range. Something else has probably happened between here or there to cause that. Mark, I'm assuming you concur with that the skew is by no means a hard and fast rule. It's more of a guesstimate of where things should be.
Well, if you talk to the academics, they'll tell you that skew maybe shouldn't even really exist. If you believe in Black Scholes, skew should be non-existent.
That's the academic versus practitioner argument.
Yeah, and on the practitioner side, skew really is just the invention of breaking apart of supply and demand. The whole world wants puts. The whole world wants to sell calls, and that creates a skew. And that was the one point is, and it's not always that way. In Japan, for instance, and this is a quote from Goldman, Japan has almost a reverse skew in the Nikkei, where basically calls are more expensive, and it has to do with how people hedge and the different types of trades that people put on. So, the U.S. is significant in that it has the steepest skew in the world, whereas the DAX and some of the other names don't. So it's not I don't consider skew, or the ratios of skew to be, one, an arbitrage opportunity, or two, predictive, other than they show supply and demand. And there's actually proof out there, some interesting studies out there that basically show when skew's steep, that's actually super bullish, and it's only when it gets flat where nobody's hedged that it's time to hit the bricks and run for the hills. So it's actually counterintuitive as well.
Yeah, I could certainly make the argument now maybe for the downside in the S&P. We're hitting record highs every day, and yet not as hedged, not as much of a put premium as you might expect. So you can maybe make that argument out there as well. But I think a good example of this, Mark, what we were just talking about, crude oil. How many times did that skew shift intra-week when that thing was rocking and rolling? Huge bid to the puts. No love at all for the calls, huge discount. A week later, a few days later, that would shift and everyone was loading up on the upside. I remember particularly, I think when crude first broke through the 60 handle to the downside is when everyone and their mother lined up on the upside. They said, you know what, this is, I have to fade this. I have to get long. The CFTC Commitment of Traders report came out and everybody was long crude, the futures, the options, and they all got burned as crude kept going down to the 40 handle. And so we did see a lot of different. But again, you're right. It's all supply and demand. It's all order flow.
Well, then as Citi predicted, crude went right to 20.
You love that guy. You're never going to let up on that guy. I forgot his name, but hopefully he listens and he's been suitably chastened.
I hope so. And funny thing is, have you heard about him being fired?
No, why would he be? He got more ink than anybody else there. That's what they want.
One of the worst calls in the last 10 years, and he's probably getting a promotion.
People have learned this model in the analyst world. Look at every time people write about a stupid Apple TV or the Apple car, they have no idea what they're writing
Apple
about.
Watch.
Yes, but they do it years in advance. They get a ton of ink. And then by the time it actually happens, or if it does happen, it's years later and it doesn't matter. In the meantime, they've generated tons of ink, tons of links. That's what the analyst game is. I know we take a bit of a dismissive view on it. And we have a lot of analysts listening, so we love you. Keep tuning in. Well, I love our listeners, so great questions. Next one comes in from James. James B. He writes, why is implied vol different between the put and the call of the same strike? In his book, Dynamic Hedging, our good friend, Mr. Nassim Taleb, says that the volatility of an out-of-the-money put should be exactly equal to that of a corresponding in-the-money call of the same strike. But in options chains, the calls always have a slightly higher implied vol than the corresponding put. Is this because I'm looking at American option chains and not European? Well, American certainly are going to give you a little bit of that extra call juice there. What was your name here, James? Because you have that early exercise premium. It's going to be negligible on these deep in the money. That's why he even says here it's slightly higher. But that's probably what's causing that little bit of distortion in your models, that your model is factoring in a little bit of early exercise premium, and that's causing a little bit of increased premium that translates in your model to a corresponding little bit tick higher of implied volatility. Again, that's why we talk about the difference between theory and practice. Sometimes what happens in the real world, a little bit different than what's going on in the model. Mr. Greasy Meatball, anything you want to add to our friend here, James, who's scratching his head, saying that what Mr. Taleb says and what the markets are saying are two different things?
Well, and don't forget that in the money options always have a much wider strike width. So the bid-ask spread is usually 50 cents as opposed to 5 cents.
That's true.
And so you get a much more accurate picture of what the actual volatility is on the puts. I generally would just ignore the volatility on the calls unless it's a tight market. And I would, obviously look at it, see if something actually is off. Another issue you might be having is, and this is especially true in the indexes, most brokerage firms, save one or two, are not, and this is abhorrently bad, but they're not sophisticated to figure out that you don't actually use the cash index for the underlying and you use the forward value at expiration. So, for instance, in the SPX, right now the SPX is what 1210 something, or excuse me, 2110, something along those lines. And when you look at the dividend out to June with zero interest rates and a dividend out to June, the future actually trades at a discount. So the forward value is actually off, and so the forward value would, potentially affect or does actually affect the volatilities affecting calls and puts, and that's how they can end up wrong. And we see the same thing in VIX, NASDAQ, Russell 2000, all the major cash indexes. The underlying price should be priced off of the forward roll price, not the cash index.
It is amazing, and I see that a lot with a lot of different brokerage firms still, you're right, to this day, and it is amazing how, 2015, with all the sophistication we have and how much money goes into these platforms, these still little nuances are still problems.
That's not even a little nuance. I mean, how it's super easy to come up with the forward roll, especially on a quarterly like this. I mean, we know what the forward roll of the forward roll value of the S&P 5 of the SPX is for June expiration. It's whatever the June future is trading. And, it's kind of ridiculous that nobody can figure that out.
It's true. I mean, they have it right there in front of them. They don't need to do any extra work.
They don't need to do anything.
So the moral of the story, though, is that as he points out rightly here, is that, all of these differences should add up to, you're talking about deep in the money calls, a relatively nominal amount compared to the value of that call, let alone, like Marcus pointed out, the size of that spread. So it shouldn't be something that keeps you up at night. But if you're wondering why your model is, maybe a tick off or you can't make sense of it, that's all those reasons are probably why there. James, Mr. B, good questions, everybody. Got some other ones here from Nanny State, Mr. Stevens. We won't have time to get to those. Maybe we'll get to those on the next show. Meanwhile, we have to keep on rolling into our final segment. It's time for the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody. It's time for the crystal ball. This is the portion of the show you have to kind of put your seatbelt on and buckle in to feel the G's, because it's time to butcher a Simpsons quote. But of course, it's time for us to prognosticate wildly and indeed recklessly about the future of volatility. As we've been recording the show, the sell-off has increased somewhat a bit to the downside. I said at the top of the show it was kind of negligible. Most of the major markets off fractionally or unched. Now they're all off more than over half a percentage point on the day, about 0.6 on the S&Ps of a percentage point, and similar levels on the Dow. So we'll see as the day progresses. Maybe you got an hour or so left in the day if this turns into something interesting. VIX cash just ticked over the 14 handle as well. So that sets you up, listeners, for where we are now as we look ahead to the week that comes from a vol perspective. Mr. Sebastian, we were just remarking at the top of the show here about how not a heck of a lot going on, and VIX kind of flirted with some upside, then it kind of gave it up, kind of flirting with it again. What's your take a week from now as we gather together once again on the Volatility Views program? I think this is kind of an aberrant blip, or are we going to be probably hovering in the 12.5 or 13 range, or you think we're going to see more upside?
Well, we're got non-farms next week. We'll have some sort of Greece resolution in the next couple of days. I could see, I would put a 90 delta that we're below current price, 90, but if one of those things really goes haywire, that's how the VIX gets higher. I feel like after we broke that 2120 level, that was really the market saying, all right, well, the next move will be higher. And I think that we'll get there. It just may take a little time. We've failed to dip below 2100 since we broke, and or be able to settle there. So I think that you're looking at a market that where the path of least resistance is up until we have some sort of catalyst to change that. And I don't see Greece or non-farm payrolls doing it. And with the GDP being negative, I could see a situation where we get some assurity that the Fed's not doing anything till September or December or whenever, and the market goes off to the races.
Yeah, you're already closing in almost on that June meeting, so you can cross that off the steak list.
Jared is going to buy me the best steak. I mean, that is going to be so awesome.
It will be a tasty, tasty steak. And you're right, next non-farms are next week. I'll maybe do a little due diligence ahead of the show next week to see kind of what premium, if any, kind of seeps into the market ahead of the non-farms, or if it's another non-event. And coming out of that, of course, by the time we record the show, it'll all be said and done. So we'll dig into it maybe on Thursday night and see if we got people keeping their powder dry going into non-farms the way they used to in days of old, or whether they're just shrugging it off again as they have done a lot until very recently, when we were reminded that non-farms can indeed move the market on a few occasions. All right, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. And before we go, as always, let me check in with my cohort here, my partner in crime, to see what he's cooking up that may interest you, the volatility traders among us. Mr. Mark Greasy Meatball Sebastian, what is cooking in the land of Option Pit that may interest our listeners?
You know, the Option Pit boot camp starts a week from Tuesday, June 9th, and it's going to be 4 days of intense options and derivative education. And if you're interested in learning really about how volatility trades, this is a great way to start. Go to optionpit.com/events to check it out.
So is there a lot of calisthenics and obstacle courses involved in this boot camp?
Yes, volatility calisthenics.
Will you be wearing a nice drill instructor hat and a whistle?
You know what? I'll have my combat boots on.
Somehow I think that's a regular day for you in the office over
Indeed.
there. Well, check that out, listeners. Surf on over to optionpit.com. Still some time to get in there and register if you're indeed interested in some volatility calisthenics. And on behalf of the Greasy Meatball and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them coming. Maybe we'll have an all question and answer show one of these days just to get all your questions up here on the show. But keep them coming. Love to hear from you. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.